In 2008, the median American home price collapsed by 33%. Millions of families lost everything. Banks failed. The government spent $700 billion just to stop the bleeding. That was called the worst housing crisis since the Great Depression. What is happening right now is structurally different, more complex, and reaches deeper into the financial system than anything that happened in 2008. And almost nobody in the mainstream financial press is connecting the dots correctly. This is not a crash caused by subprime mortgages or reckless borrowing by unqualified buyers. The buyers today are qualified. The banks today are technically solvent. The Federal Reserve is not panicking. And yet the housing market has quietly entered a state of functional paralysis that is beginning to metastasize into the broader economy in ways that have not been seen in the post-war era of American finance. The machinery of real estate, which has powered wealth creation for 3 generations of American families, has seized. And the silence around this seizure is the most dangerous part of the entire story. Before we dismantle exactly what is happening layer by layer and follow the money through the institutions that are most exposed, make sure you are subscribed to this channel. What you are about to hear is not a prediction. It is an accounting of a process that is already underway. The numbers are real, the mechanics are real, and the consequences for every American household, whether they own property or not, are coming. Let us start with a number that reframes the entire conversation. The Housing Affordability Index, published by the National Association of Realtors, hit its lowest reading in the history of the measurement in late 2023 and has barely recovered since. What that index measures is simple. It asks whether a family earning the median household income can afford to purchase a median-priced home. For most of the post-war era, that index sat comfortably above 100, meaning the median family could afford the median home with room to spare. Today, the index sits below 100 in virtually every major metropolitan market in the country. In cities like Los Angeles, San Diego, Miami, and New York, the index has collapsed to levels that imply you would need an income of roughly $200,000 to qualify for a standard 30-year mortgage on a median-priced home. The median household income in the United States is approximately $78,000. This is not a market that is overheated. This is a market that has formally broken the connection between the price of housing and the wages of the people who are supposed to live in it. To understand how this happened, you have to follow the sequence of events that began in March of 2020. The Federal Reserve dropped the federal funds rate to effectively zero and began purchasing mortgage-backed securities at a pace of $40 billion per month. This was intended to stabilize the financial system during the pandemic shock. What it actually did over the following 24 months was inject an extraordinary volume of cheap capital into the housing market. 30-year mortgage rates fell to historic lows of 2.65% in January of 2021. At those rates, a household earning $75,000 per year could qualify for a mortgage of roughly $350,000, enough to buy a home in most mid-tier American cities. That liquidity created a demand surge unlike anything the market had seen since the early 2000s. Home prices nationally rose 43% between January 2020 and June 2022, 43% in 2.5 years. That is not appreciation. That is a liquidity-driven price distortion of historic proportions. Then, the Federal Reserve reversed course. Beginning in March 2022, the Fed raised interest rates at the most aggressive pace since the early 1980s, lifting the federal funds rate from near 0 to over 5% in just 16 months. The 30-year fixed mortgage rate, which had sat below 3% for most of 2021, crossed 7% by the end of 2022 and has remained above 6.5% ever since. This created what economists and mortgage analysts now call the lock-in effect, and it is the central mechanism of the current paralysis. A homeowner who purchased a house in 2021 at a 3% mortgage rate and is now sitting on a property that has appreciated significantly on paper has absolutely no financial incentive to sell. If they sell and attempt to purchase another home of equivalent size in the same market, their monthly mortgage payment would roughly double. Not because the house costs more, though in many cases it does, but because the cost of borrowing the money to buy it has more than doubled, so they stay. They do not list, they do not move. The inventory of existing homes for sale, which normally hovers around 1.2 to 1.5 million units nationally, collapsed to under 500,000 units by early 2024. That is a supply shock of extraordinary magnitude. And into that supply vacuum, prices did not fall the way economic models predicted they would when affordability collapsed. They held. In some markets, they continued to rise. Not because demand was strong, but because the supply was frozen. Transaction volume tells the real story. Existing home sales, which averaged roughly 5.3 million units annually in the decade before the pandemic, collapsed to approximately 4 million units in 2023, the slowest pace since 1995. That is not a soft landing. That is a market that has stopped functioning. When a market stops clearing, when buyers and sellers cannot meet at a price that works for both parties, the capital that would normally circulate through real estate transactions stops moving as well. Mortgage originations, refinancing activity, title insurance, home improvement spending, real estate agent commissions, moving companies, furniture retailers. Every downstream industry tied to residential real estate transaction volume is experiencing a severe contraction. The National Association of Realtors reported that approximately 60,000 real estate agents left the profession in 2023 alone. That is not a market in transition. That is a market in contraction. But here is where the story becomes structurally dangerous in ways that go far beyond the individual homebuyer who is priced out of the market. The paralysis in residential real estate is beginning to intersect with a separate but simultaneous crisis in the commercial real estate sector. And the collision point is the regional banking system. Regional and community banks in the United States hold approximately 70% of all commercial real estate loans outstanding. The total commercial real estate loan book in the United States is approximately $5.8 trillion. Of that, roughly $1.5 trillion in loans are scheduled to mature by the end of 2026. Requiring refinancing in an interest rate environment that is dramatically more expensive than when those loans were originated. A commercial office building that was financed at a 3.5% interest rate in 2019 and is now approaching maturity faces refinancing at rates between 7% and 9%. For that building to qualify for refinancing, the lender needs the property to generate sufficient net operating income to cover the new debt service. But office vacancy rates have surged since the pandemic, driven by the structural adoption of remote and hybrid work arrangements. The national office vacancy rate crossed 20% in 2024, according to data from CBRE, the largest commercial real estate services company in the world. In specific markets like San Francisco, vacancy has exceeded 35%. These buildings are not generating the income needed to service their debt at current rates, and the lenders know it. The response from the banking sector has not been to foreclose aggressively. It has been to extend and pretend. Banks are granting loan extensions, modifying terms, and deferring the recognition of losses on their books in the hope that interest rates will fall before the full weight of the problem has to be acknowledged. The Federal Reserve and the FDIC are watching this practice closely and with considerable unease. In their January 2024 Financial Stability Report, the Fed specifically flagged commercial real estate as one of the primary vulnerabilities in the banking system, noting that valuations remained elevated relative to fundamentals and that the potential for credit losses at banks with concentrated CRE exposure was significant. That is the language of regulators who are watching a problem develop in slow motion and calculating whether they have enough tools to contain it when it accelerates. The numbers behind that concern are sobering. According to analysis from the research firm Capital Economics, office property values in major U.S. cities have already declined between 40% and 50% from their 2019 peaks on a mark-to-market basis. That means a building that was worth $100 million in 2019 is worth approximately $50 to $60 million today, based on actual comparable transaction data. But that building may still be sitting on a regional bank's balance sheet at close to its original value because the loan has been extended and the bank has not been required to write it down. This gap between the book value and the market value of commercial real estate collateral held by regional banks is estimated to represent hundreds of billions of dollars in unrealized losses. Moody's Analytics has estimated that a severe commercial real estate downturn could result in losses significant enough to threaten the capital buffers of a meaningful number of the roughly 4,800 community and regional banks operating in the United States. This is not theoretical. In early 2024, New York Community Bancorp disclosed significant losses tied to its commercial real estate loan portfolio and saw its stock price drop more than 60% in a matter of days as depositors and investors processed the implications. NYCB was not a small institution. It had over $100 billion in assets. The panic that its disclosure triggered was a preview of the contagion dynamic that regulators are working urgently to prevent. Because regional banks are not just lenders to commercial property owners. They are the primary source of credit for small businesses, local developers, and residential construction projects across the country. If the commercial real estate losses on their books are large enough to constrain their lending capacity, the credit contraction that follows touches the entire economy. And here is where the residential housing crisis and the commercial real estate crisis converge in a way that is not widely understood. The construction of new housing, particularly affordable single-family homes and workforce multifamily apartments, depends almost entirely on financing from regional and community banks. The national home builders, the publicly traded companies like D.R. Horton and Lennar, access the bond market and have sophisticated capital structures. But the local builder who constructs 50 homes a year in a mid-sized market, or the developer who wants to build a 120-unit workforce apartment complex in a suburb of a major city, those projects are funded through construction loans from regional banks. If those banks are under capital pressure from their commercial real estate losses, if they are tightening lending standards and pulling back from new originations to preserve their balance sheets, then the pipeline of new housing supply that could theoretically ease the affordability crisis stops flowing. The constraint on supply that was created by the lock-in effect on the demand side is being reinforced on the supply side by a credit constraint that is a direct consequence of the commercial real estate problem. The two crises are amplifying each other. That is a structural feedback loop, not a market correction. Simultaneously, the insurance market is undergoing a disruption that is adding an entirely new layer of pressure to housing costs in ways that standard affordability metrics do not fully capture. State Farm, the largest home insurer in the United States, announced in May 2023 that it would stop writing new homeowners insurance policies in California, citing wildfire risk and the rising cost of reinsurance. Allstate made the same announcement. Farmers followed. In Florida, which had already been dealing with an insurance market crisis driven by hurricane exposure and litigation costs, the situation deteriorated further. Average annual homeowners insurance premiums in Florida surpassed $6,000 in 2024, compared to a national average of approximately $1,700 annually. In coastal Louisiana and parts of Texas, insurance costs have risen to the point where for many older, lower-value homes, the annual premium exceeds 3% of the property's value. That is an enormous carrying cost that makes ownership of those properties economically irrational for anyone who is not paying cash. The insurance crisis matters to the housing market in a way that goes beyond monthly affordability calculations. If a property is uninsurable, or if insurance is available only at a cost that makes the total housing expense prohibitive, lenders will not write mortgages on those properties. The Federal Housing Finance Agency, which oversees Fannie Mae and Freddie Mac, began requiring that properties in high-risk areas demonstrate insurability as a condition of mortgage eligibility. Properties that cannot meet that requirement can only be purchased by cash buyers, and cash buyers in distressed or high-risk markets are typically institutional investors or speculators who price assets accordingly, which means at a significant discount to the market values that neighboring insured properties carry. When a significant number of properties in a neighborhood or a coastal zip code lose their insurance eligibility, the comps for every surrounding property are affected. Property values in those areas are beginning to reprice, and that repricing is not yet fully reflected in the aggregate national home price indices that headline writers use to assess the state of the market. The property tax system is adding further pressure that compounds the affordability problem for existing homeowners. During the 2020 to 2022 price surge, local governments reassessed property values upward in many jurisdictions, capturing the nominal gains of the boom in higher tax assessments. In Texas, which has no state income tax and therefore relies heavily on property taxes to fund local government, assessed values in major metropolitan areas rose dramatically. The effective property tax burden on many Texas homeowners increased substantially even as their mortgage payments remained fixed, because the property tax component of their monthly escrow payment rose in parallel with the assessments. For homeowners on fixed or stagnant incomes, particularly retirees and working-class families in rapidly gentrifying areas, this combination of locked-in mortgage costs and rising insurance and tax obligations is creating a cost structure that is not sustainable without income growth that has not materialized. The term cost burdened, defined by the Department of Housing and Urban Development as spending more than 30% of gross income on housing, now applies to more than 40% of American renters and a growing percentage of homeowners. At the upper end of that distribution, the degree of cost burden has become severe enough to function as a structural constraint on consumer spending in other categories. This matters enormously for the broader economy because residential real estate and the consumer spending it enables are not peripheral to American economic growth. They are central to it. Housing construction, real estate transaction activity, and the home improvement and furnishing spending that follows residential moves collectively represent approximately 15 to 18% of GDP in a normal market cycle. When that sector seizes, the multiplier effects work in reverse. The building supply retailers, the appliance manufacturers, the mortgage brokers, the title companies, the moving companies, the painters and plumbers and electricians who depend on a functioning housing transaction market for their income all feel the contraction simultaneously. The Bureau of Economic Analysis data for 2023 and early 2024 showed residential fixed investment contracting for 8 consecutive quarters, a run of weakness not seen since the aftermath of the 2008 crisis. Residential fixed investment is the technical measure of spending on housing construction and improvement. 8 consecutive quarters of contraction is a depression in the housing construction sector by any reasonable definition of that word. Now, the Federal Reserve is watching all of this and calculating its response with full awareness of the trap it has constructed. If it cuts rates aggressively, as the housing market needs it to, in order to unlock transaction volume and new construction financing, it risks reigniting the inflation that the rate hiking cycle was designed to suppress. Core inflation, which excludes food and energy, remained above the Fed's 2% target throughout 2024, driven in significant part by shelter costs. The shelter component of the Consumer Price Index, which measures rent and the imputed rental value of owner-occupied homes, has remained stubbornly elevated because the actual rental market, which the CPI tracks with a lag, is still digesting the price increases of 2021 and 2022. This creates a situation where the Fed's primary inflation measure is being kept elevated partly by the very housing cost pressures that the high interest rates are making worse. It is a circular constraint that limits the Fed's ability to ease policy without risking an inflation resurgence. On the other hand, if the Fed maintains high rates for too long, the commercial real estate maturity wall will become impossible for the banking system to manage without explicit government intervention. The extend and pretend strategy has a time limit. Loans cannot be extended indefinitely. Regulators cannot look the other way indefinitely. At some point, the losses must be recognized, and when they are, the capital implications for the regional banking sector will be significant. The FDIC's problem bank list, the internal watch list of institutions the agency is monitoring for elevated risk, expanded substantially in 2023 and 2024. The agency does not disclose the specific names on that list to prevent triggering the very bank runs it is trying to prevent, but the aggregate data is public and the trend is clear. The political dimension of the housing crisis is also driving policy responses that are worth tracking carefully because they will determine the trajectory of the market over the next several years. The Biden administration launched a series of initiatives in 2023 and 2024 aimed at increasing housing supply, including efforts to streamline zoning reform at the local level, incentivize the conversion of unused commercial space to residential units, and expand financing for affordable housing construction through Fannie Mae and Freddie Mac. The Trump administration entering office in 2025 brought a different set of priorities, but housing affordability remained politically radioactive across partisan lines because the problem is visible and universal. Proposals to reduce regulations on new construction, open federal lands to development in some markets, and use tariff revenue to subsidize mortgage rates have been floated, though the implementation timelines for any of these measures extend years into the future. The market cannot wait years. The maturity wall is now. The affordability crisis is now. The migration pattern data is one of the most telling indicators of how households are responding to a market that has effectively priced them out of their preferred locations. The United States Postal Service change of address data and the Census Bureau migration estimates consistently show net outflows from high-cost coastal markets and net inflows to lower-cost Sunbelt and Mountain West cities. This pattern, which accelerated dramatically during the pandemic as remote work freed many knowledge workers from geographic constraints, has continued even as return-to-office pressures have mounted. The cities receiving these migrants, places like Nashville, Austin, Charlotte, Phoenix, and the suburbs of Atlanta, experienced their own affordability crises as the demand surge outpaced local housing supply. Austin, which was celebrated as a success story for new housing construction after aggressive upzoning, saw apartment rents fall in 2023 and 2024 as supply caught up with the pandemic demand surge, offering a useful demonstration that supply does in fact relieve price pressure when it is actually permitted to be built. But Austin is an exception. In most of the receiving markets, zoning restrictions and community opposition to density have slowed the supply response and created new affordability constraints in places that were once cheap. The rental market tells a particular story about who is absorbing the consequences of all of this structural disruption. The home ownership rate in the United States, which peaked at 69% in 2004 before collapsing in the wake of the 2008 crisis and recovering partially to approximately 65% in the early 2020s, has stalled and in some age cohorts declined. Among adults under 35, the home ownership rate has declined to approximately 38%, compared to roughly 44% for the same age cohort in 1982, a period when mortgage rates were far higher than today, but home prices relative to incomes were far lower. The arithmetic of home ownership has deteriorated so substantially for younger Americans that the behavioral response is not just delayed purchase. It is the growing acceptance that ownership may never be accessible. That psychological shift has implications that extend beyond housing. Home ownership has historically been the primary vehicle for household wealth accumulation for the American middle class. The Federal Reserve's Survey of Consumer Finances consistently shows that homeowners have median net worths multiple times higher than renters. If a generation is systematically excluded from that wealth-building mechanism, the long-term consequences for household balance sheets, consumer spending capacity, and the social stability that comes from economic participation are substantial. The institutional investment angle of this story is real, but is frequently mischaracterized. Institutional investors, including real estate investment trusts, private equity funds, and corporate landlords like Invitation Homes and American Homes, for rent, have purchased single-family homes at scale, particularly in Sunbelt markets, since the aftermath of the 2008 crisis. The actual percentage of the single-family stock owned by institutional investors nationally is estimated at between 3% and 5%, which is lower than often cited in viral social media content. However, in specific submarkets and specific price tiers, their market share is substantially higher. In Phoenix, Atlanta, and Charlotte, institutional buyers accounted for a meaningfully larger share of transactions in the $200,000 to $400,000 price range during the 2020 to 2022 buying frenzy, and their concentration in those entry-level price points had a disproportionate effect on affordability for first-time buyers competing in that specific segment. The more significant and less discussed institutional dynamic is what is happening now, as rising interest rates and rising operating costs have compressed the return on investment for the single-family rental model. Invitation Homes reported declining same-store net operating income growth in late 2023 as property tax increases, insurance premium spikes, and maintenance cost inflation ate into margins. The institutional landlord trade that seemed bulletproof at 2021 valuations and 2021 interest rates is under meaningful stress at current costs. And the question of whether these portfolio holders will become net sellers over the next several years as their financing costs reset is a material variable for the trajectory of housing prices in the markets where they are concentrated. The construction side of this equation is where the longer-term structural story becomes most troubling. The United States has been systematically underbuilding housing relative to household formation for more than a decade. The National Association of Realtors estimates the cumulative housing deficit at approximately 5.5 million units. Freddie Mac's estimate is slightly lower at 3.8 million units. The precise number is debated, but the existence of a substantial structural shortage is not. This deficit was not created by the pandemic or by the Fed's rate hiking cycle. It was created over more than a decade by a combination of local zoning restrictions that prevent density, labor shortages in the construction trades, rising materials costs, and the financial stress that the 2008 crisis imposed on the home building industry, which had experienced workers and capital capacity that took years to rebuild. The rate hiking cycle made this existing deficit worse because it raised the cost of construction financing and the cost of the mortgages that would be needed to sell newly constructed homes. Housing starts, which measure the number of new residential construction projects initiated, remained depressed relative to pre-pandemic trend levels throughout 2023 and early 2024. Single-family starts in particular fell to levels that, if sustained, would widen the structural deficit further over time rather than close it. This is the structural picture in its full dimension. The housing market has not collapsed in the sense of a sudden, visible, dramatic price crash that shows up in the headlines. What it has done is more insidious. It has entered a state of paralysis in which the normal mechanisms of price discovery, supply response, and household formation are all impaired simultaneously. Transaction volume is severely depressed. New construction is insufficient. Insurance costs are rising sharply in risk-exposed markets. Property tax burdens are increasing. Commercial real estate losses are beginning to constrain the banking system's capacity to finance new residential supply. And the Federal Reserve is trapped between the inflation that easy money would risk and the financial system's stress that tight money is creating. The process is not over. The commercial real estate maturity wave is still working its way through the system. The insurance market repricing in climate-exposed regions is still in its early stages. The credit implications for regional banks are still being calculated by the rating agencies and regulators. The inventory lock-in effect will persist as long as the spread between the mortgage rates locked in by existing homeowners and the market rates available for new purchases remains as wide as it currently is. The resolution of that lock-in will require either a substantial decline in prevailing mortgage rates, which the Fed can engineer only by accepting lower growth and lower inflation, or a prolonged period of time during which sellers are forced to the market by the economic pressures of life regardless of the rate environment, gradually rebuilding inventory. What happens next depends on which of these pressures resolves first and in which direction. If inflation remains sticky and the Fed cannot cut rates meaningfully through 2025 and 2026, the commercial real estate maturity wall will hit a banking system that has less capacity to absorb it than it did a year ago. Regional bank lending will tighten further. Construction financing will become more difficult to secure. New housing supply will remain constrained. Affordability will not improve. The divergence between what housing costs and what wages support will continue to widen. In that scenario, the markets that are most exposed to insurance withdrawal and property tax increases will begin to see price declines that the aggregate national indices will obscure until they become too large to mask. If the Fed does begin cutting rates more aggressively in response to economic weakness or banking system stress, the immediate effect on the housing market is not straightforward. Declining rates could attract buyers who have been sitting on the sidelines, But if that demand surge is not met with an increase in inventory, prices could rise rather than fall, worsening affordability even as monthly payments become more manageable. The supply response to lower rates is slower than the demand response because construction takes time. The industry needs financing, labor, permits, and infrastructure before a new home can be occupied. That process takes years, not months. The mismatch between the speed of demand and the speed of supply is a structural feature of the housing market that rate policy cannot fix quickly. The data will continue to come in. The FDIC will continue publishing its problem bank list statistics. The commercial real estate servicers will continue reporting their delinquency data. The Census Bureau will continue tracking housing starts and building permits. The National Association of Realtors will continue publishing its affordability index and its transaction volume data. Each of those data points is a piece of the structural picture. None of them in isolation tells you the whole story. Together, they describe a system under sustained and compounding pressure, a market that has not collapsed but has fundamentally changed its behavior in ways that carry significant consequences for the households, the financial institutions, and the local governments that depend on it functioning normally. The numbers are telling you something that the headlines are not. If you are watching what is moving through the credit markets, what is happening to regional bank balance sheets, what is happening to insurance availability in coastal markets, what is happening to construction financing pipelines, you are seeing the same data the institutions are seeing. The housing market's structural stress is not a future event to be debated. It is a current condition to be understood. Follow the data as it develops. The process is still unfolding, and the next phase of it will be determined by decisions being made right now in bank boardrooms, at the Federal Reserve, in state insurance commissioner offices, and in the balance sheets of the institutional landlords who are quietly reassessing their exposure. Subscribe to this channel if you want to continue following this analysis as the data evolves. This is not about fear. It is about understanding the mechanics of a system under pressure before that pressure reaches a resolution.